Welcome to the MUFG Global Markets Podcast. I'm John Cook, and today I'm joined by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, December 12th, 2023. Welcome back to the podcast, George.
Great to be back on, as always.
Yeah, and good to have you, as always. So, George, looks like the finish line for 2023 is finally upon us. This week is clearly the last week from a major event perspective, whether we're talking CPI or the Fed or the ECB or the BOE. Since our last conversation on air, since our last episode, the markets, have certainly seen vols decline, especially in stocks and FX. Treasuries, treasuries continue to rally, but perhaps are starting to put in a top. Stocks trade well. Why don't we set the stage for our listeners with kind of what you think the dynamics that markets are experiencing, currently, perhaps before the next major move?
Yes, it's been really the continuation of what we cataloged in our last podcast. The early start of the Fed pivot, end of inflation, and the idea that we can soft land as this kind of immaculate disinflation will result in minor Fed cuts. And so we've had this, really this belief, trigger one of the biggest rallies in a 1 month period. Like November was one of the best months on record for the stock market for the month of November. We've had decent inflows into risk assets, and on the back of all that, vols have come down, and generally it's been a risk on environment. But really post Thanksgiving and through month end until till today, ahead of the Fed, we're really consolidating. So we're really seeing markets come up to resistance both in rates as well as risk assets. And so I think a lot of it was probably this short positioning that we discussed and described before, coupled with a little bit of fear of missing out, like the whole FOMO move that can exacerbate these markets, especially towards year end when it's much thinner volumes. I think all of that got us to where we are here. We just, this morning saw, CPI come in a little bit on the hotter side, but really splitting hairs if you discount the used car prices going up, which seems like a one-off. And we had what was really the Goldilocks NFP of this cycle, where you didn't have much adjustment from the birth-death model. You had really healthy household data, as you and I track closely, and really resulting in a lower unemployment rate, and putting in some distance before the SOM rule, which a lot of people are now focusing on, which is a move of greater than 0.5 from a historical low of unemployment rate. If we had moved up to like 4% or higher in the unemployment rate, that would really get people thinking that a recession is much closer. So I think we've had this kind of perfect setup of jobs market, not too hot, not too cold, the Goldilocks jobs market, coupled with inflation's going in the right direction, and now we're getting into the preparation for the Fed coming up.
And exactly what I hoped you would say. You brought up the Fed. So, George, you recently published your December FOMC preview. As I mentioned earlier, we are recording this podcast on Tuesday, December 12th, but it will be released to the public on December 13th, which coincidentally is the morning of the FOMC meeting. So we have plenty of time here to kind of discuss your views on the Fed. It's a quarterly meeting, so we get, in addition to the policy statement and Powell's post-meeting press conference, we get the SEPs. So there's a ton of information. Without going into exorbitant detail, I think what I'd like to do is just kind of give our listeners the high points of your FOMC preview.
Yeah, and so as you said, this is the final major economic and central bank week of the year. After the Fed, we do have the ECB and the other central banks that also are important. But for here, those of us in the U.S., I think a lot of it will come to a conclusion tomorrow by 3:30 once Chair Powell walks off the podium, which is usually roughly around the time when he's finishing. the press conference. But our view is that, like, given what has transpired since the last Fed meeting, which was November 1st, it's been a night and day transformation in the markets. Like we saw nearly 90 basis points rally from the top to bottom on the 10-year Treasury. You saw term premium, which was something that they were pointing to as doing the work for them in terms of tightening financial conditions. Term premium going from a positive to a negative again. Financial conditions back up at the near-term highs, stocks as well. Spreads at the historical tights for the year. So everything is basically unwound in the last 6 weeks, which were resulting in some tightening of financial conditions, which was consistent with what the Fed wanted. So now that we've had the opposite, and this is really Chair Powell's time, and the Fed in general, to kind of push back on the idea that we're not necessarily ready yet to commit or discuss, when cuts transpire. That we did see super core inflation pick back up again, and and it's not clear that the fight on inflation is over. And so I think that on the one hand, a lot of things are going in favor of the Fed. We have still relatively robust and healthy jobs market, even though on the margin things are starting to show some cracks as we've been highlighting for the last 6 months. But for now, the jobs market seems okay. Inflation is going in the right direction for the Fed. Do they need to commit to the cuts until they actually get into next year? I think that's really what I'm trying to convey. That there's really no rush. We've had a pretty tumultuous year with the banking crisis at the beginning of the year, a number of other factors that drove markets around, like higher supply concerns, and then this powerful end of year rally. I don't think the Fed wants to upset the apple carts, but at the same time, they don't want to egg on further risk taking because it's going to impart even further financial condition easing and go against what they're trying to achieve. So I think we should expect some pushback, but the challenge will be the timing and the sequence of tomorrow, where the statements come out at 2:00 with the forecast for the summary of economic projections, the SEPs, which we'll get the dots, which I'll discuss in a second. And then you have Chair Powell speaking at 2:30. And typically, like we've seen Chair Powell at his best stay on script and stay hawkish if that's indeed the message he wants to deliver. But there's times where the market starts to kind of read through it, and by the end of the press conference, we end up with, that was leaning on a dovish communication, and the market reads what it wants to read, and we might initially sell off in everything and then rally right back towards the end of the market close. So it's anyone's guess really how it ends, but I think the intent will be to deliver a slightly hawkish message to combat what has really been like nonstop financial conditions easing for about 6 weeks. On the dots themselves, again, for the record, we don't think the Fed will hike like everybody else. We've been of the view that July was the last hike. So now this will be the third time they're skipping. So they're not going to hike, most likely. They're going to give us these new economic projections with the dots. They're going to have to adjust the dots in their submissions around the fact that they did not hike one more time in 23. So that takes out one rate increase of 25 from their forward path. And so the question is, do they keep the 2 cuts for 2024 or not? I think that matters a lot. And then what happens with the long run dot? The 25 and 26 dots could go up and down depending on how submissions, if you actually look at the prior dot projections, it's very dispersed, and there's basically views on either ends of really high rates staying higher for longer to eventually rates going back, sub 3%. So there's not enough actual consensus beyond 2024 as it is. So I would expect some consensus building around what is in store for next year, and that would bring some convergence of the dots, even though they're not going to work on it together. I do think that they all kind of know where their macro models are signaling, and they understand each other's opinions. I think people can triangulate where the dots will go. So the question to me is like, what is a 2024 dot? Is it going to be just one cut because they did not hike again this year, or will they maintain 2 cuts? I think they're going to lean on the 2 cuts because it's easier to kind of communicate that if you are going to adjust policy, adjusting once is not enough, so why bother? Anything beyond 2 cuts would be very dovish. So if we like were to see like a 4 and 5/8 versus a 4 and 7/8, so we're expecting a 4 and 7/8, 4.88 roughly for the 2024 dot, implying 2 cuts for next year. And then the other wild card is the long run dot. If one person were to move up from a lower dot of 2.5 to even just 2.625, that would shift higher the long run dot, which has not changed since pre-COVID in 2019, which would be a pretty big move. I think that whoever is that person can do the same median math that I just did in my head. And if they really want to send a message, I guess they could. I think it makes more sense for the long run dots to be lifted in the next year as we get a better sense of like what is higher for longer. And we probably see a lot of academic papers written around what is neutral going forward, right? So I don't think they're going to try to push up the long run dot, but just mathematically, there's a chance that it might come through. If it's more than 2 and 5/8, then I'd be much more concerned. So I think those are the two things. It's really the outer boundaries, like 2024 versus the long run dot, and what does the market read from that, coupled into can Chair Powell stay hawkish throughout the whole press conference?
Okay, great. Yeah, so I would definitely encourage our listeners to check out George's preview because he has a lot of good charts that just helps you kind of see this visually. But in short, it sounds like you believe, and I think this is what I've heard from some clients as well. The FOMC moves the 2024 dot down 0.25% to 4 and 7/8, but that because they aren't hiking this year, that still shows 2 cuts next year. And then the question is, does the longer term dot is mathematically positioned to potentially go up? Does that happen at this meeting, or does instead that happen next year? So okay, great. So I think that was pretty comprehensive in terms of where are we here. What should you watch for the Fed? Since we're coming up on the end of the year, though, this is certainly the time where yourself and the rest of the street puts out outlook reports. Why don't we use the last bit of the episode to give our listeners a preview of what to expect from your upcoming 2024 U.S. outlook?
We'll give you just a quick tease on what to expect. I mean, we'll have our standard rate forecasts as well as views on credit spreads, as well as mortgage spreads, and really framing around the issue of was the recession delayed, or was it really deterred? Are we going to have this soft landing that now has become the base case for most people? So we're going to explore those views and what could either support it or go against it. And for us, it really comes down to these 4 tenets of the banking system, the Fed, the government fiscal policy, all relative to the private sector consumer / corporate. And like right now, we have 3 out of those 4 agents that are basically offline. Banks are not really lending. Fiscal has probably done most of what it could do in 2023, so really benefited 2023 growth. And as I've mentioned before, in many ways, 2023 was a soft landing, and now it's going to get a little bit more bumpy as we look into 24, because in order for the Fed to cut, something has to materially change, not just the path for inflation. We think that for them to really move the needle to justify the valuations that are seen in credit markets as well as risk markets, the Fed's going to have to cut a lot more. And in order for them to do that, something has to fundamentally change either on the macro or markets or both. And so far we don't see that. So the Fed's offline until something motivates them to really cut aggressively to justify valuations, and that's true for rates as well. And and you have the government, which is basically on a rate of change basis, not providing as much fiscal stimulus, and then we also have an election next year, which will be critical. So it really leaves us with the consumer and corporate sector. Can this recovery continue just based on that when we see consumers seeing their savings dwindle as well as getting further into leverage? And so we're still in a more cautious outlook, and we explore all those things and many more things throughout the outlook.
Awesome. Well, after we get a hold of that FOMC preview, we'll certainly be looking forward to the 2024 outlook. Again, as a reminder for our listeners, I encourage you to definitely check out the latest Macro to Markets publication, the December FOMC preview. And also, if you are not receiving George's stuff directly, get in contact with him. George, great stuff as always. Thanks for coming on the podcast.
Thanks, John, and a happy New Year to everybody if we don't speak again.
Yeah, you as well, and to our listeners. And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.